Good afternoon, everyone. I'm pleased that you could all join us today for the first of our three property tax sessions for owners in Nova Scotia and New Brunswick. This year's been quite a ride, and we're in a situation where we're all getting assessment notices for two provinces here within a couple of weeks. So we thought we'd try to hand out as much information as we possibly can to owners so you guys can make some great decisions. So joining me today, I'm going to moderate our session here, and joining me are members from our property tax team, including Giselle Kakamusius, Chris Job, Greg Carey, Nathan Hewitt, and Mark Turner. So, and the topic today, obviously, we're focusing in on the opening of the appeal period in Nova Scotia. Most of you would have just started getting notices yesterday and today, but hopefully we're going to leave you with a lot of information that you can use when you're reviewing them, and you can check back with us in a couple of weeks if you're looking for more information as to what's happening with other properties and things like that. So what we're going to talk about today, really quickly, we're going to talk about broad asset classes impacted by COVID-19. We're going to talk about what the property tax implications are. We're going to help you identify what issues are relevant and when. So in Nova Scotia, some are going to be relevant for 2021. Many won't be relevant till 2022. We're going to dive into some individual asset class considerations, and we're hopefully going to leave you a little bit of strategy as well. So what we're looking at today, we're going to try and leave you with information on things like hotels and hospitality, restaurants, convention centers, airports, seniors housing, retail, offices, schools, rec facilities, apartments. You know, apartments in Nova Scotia are an interesting one. You would have seen that there's been a flight to safety, and maybe some apartment values have actually increased quite significantly. But if you own the assets here, you would have just learned that we're having rent control slapped on us until the end of the state of emergency. So, and then last, we've got a really interesting one here on partially completed development projects of all classes. So with that, I'll be turning it over to my team shortly here. But what we'll point out here, and this will help you as we go through the presentation. This is about the when. So in Nova Scotia, we've got a base date of January 1st, 2020. And we've got a physical state date of December 1st, 2020, meaning that a lot of the market-oriented stuff won't be relevant in Nova Scotia for appealing the assessment notices that you're going to get. We do have some angles that we're working on some of those things, so it's not all bad news. However, if you own properties in New Brunswick, the base date is January 1st, 2021. You're going to be getting notices on January 27th, and everything is fair game in New Brunswick. Similarly, PEI is as well, but you won't be getting your notices until May for those ones. So with that, I'm going to turn it over to Giselle, and she's going to walk you through some of our, the first portion of these asset classes.
Thanks, Andre. So my colleagues and I, as Andre mentioned, will now turn our attention to some of those property types that were most profoundly impacted by the pandemic. And in each particular case, as we work through, we're going to speak to what assessment trends are looking like so far. We track every assessment in the province with a value of over $500,000 annually. So I think we've got a pretty good handle on the patterns and how things fall and what the trends are. We're going to talk about what we expected to happen, asset class by asset class, and we'll talk about the factors you should consider in evaluating the fairness of your 2021 assessed value, and probably most importantly, we're going to answer the question that's probably on everyone's mind, which is whether or not COVID is a relevant consideration for 2021. And you're going to hear a common refrain from us over the next 25 or so minutes, and that's really that it can be. And keep in mind as well, while we'll be speaking to some specific property types, the valuation issues that we're going to be discussing will also often have some broad application across commercial and investment grade real estate generally. So hospitality property, I don't think you need to look any further for a poster child to illuminate the problems that are inherent with that base date lag that Andre was speaking about, and that's the circumstance that we find ourselves in Nova Scotia. In 2021, you're going to be paying taxes in the most dismal of times based on values that reflect the market arguably at its peak. So back, reflecting 2019's operating results. The assessments themselves on hospitality for 2021 show a really odd pattern. Overall, the median increase for hotels across the province is about 1%. Restaurants are showing a median of 0, but you know that old saying, if you have one foot in a bucket of freezing water and the other in boiling, that overall you're warm. It's kind of the case here. There's a very wide deviation around those medians that I just mentioned. I was surprised to see that 10% of hotel owners are going to see a double-digit increase, and about a quarter of restaurants are going to increase by 20% or more, which is so strange because I hadn't expected to see much movement in this sector at all. You know, even though before we start talking about COVID, I think that 2021 values need a hard look. There are some factors at play. You know, visitors and tourism revenues were down 4 to 5% in 2019, obviously with some variation around that average. And with market cap rates staying constant, my take is that many values should come down even prior to COVID-related concerns. I think there was some modestly heightened risk facing the industry relevant to the 2021 base date from other factors other than COVID, and relevant to the base date that should be considered. Bookings on the shared economy platform were up 40% in 2019, so Airbnb and so on. The Yarmouth Ferry wasn't running, which had a fairly profound effect down on the south shore of the province. The Boeing MAX aircraft had been grounded. Hurricane Dorian was a disruptor in the second half of the year. So, you know, for assessment valuation purposes, a lot of these factors go to risk, and risk, of course, is reflected in capitalization rates. And we haven't seen any material movement in the assessor's cap rates here in Nova Scotia for a number of years, and I'm thinking that for 2021, it's probably time for that. Bottom line is that I think that there are probably some knobs to turn and some opportunity for reduction even before we turn the page for on assessments to 2022 when COVID's going to be front and center. And that's true for restaurants too. Any property really with deferred maintenance and or a pending reimage or a property improvement plan as of the date's evaluation should definitely be reviewed. You know, and the other thing too is that challenging your 2021 assessment provides the opportunity to open a dialogue with PVSC respecting the impact of COVID on your business. PVSC wants this information. It's going to help them in setting 2022 assessments, not only for your property, but for others as well. So COVID, right off the bat, as some of you may be aware, if you're in that sector, the province has commendably put a tax relief program in place for hotels to reduce their 2021 taxes. But keep in mind that this is for the 2020 assessment year and not for 2021. So you're going to be back to full strength in terms of taxes come April the 1st when that municipal calendar turns over. Bit of an editorial comment here. I think it's a real shame that this program didn't extend to other hospitality, you know, market participants, restaurants, and so on. So what to consider in terms of having COVID taken into account in setting of your 2021 assessment? Think to yourself, if you had areas in your facility that were closed at December the 1st, in other words, if the restaurant was closed or at partial capacity, if your fitness facilities were shut down, if your spa was shut down, or if you didn't, if your you know, if your your customers rather didn't have access to some of the common amenities, this is a relevant consideration. And really what you need to do is think to yourself what room rates you'd command in a January 2020 world, but without access to those amenities. Bottom line, in terms of hospitality, I think it'd be the exception rather than the rule that I'd recommend not to appeal. And that's going to be especially true for our next property type, which is new and partially complete construction. And the valuation at the best of times of this particular property type is a bit of an enigma wrapped up in a riddle. Because with new construction, anything in the ground as of the 1st of December 2020 is accessible for 2021. But the devil's in the details, particularly for 2021, because the value on your notice reflects land plus the value of any construction in place as of the 1st of December, but reflecting market conditions as of the 1st of January 2020, so almost 12 months prior. Still with me? Okay, so in order to insert new construction onto the 21 roll, PVSC undertook a request for information program for properties with open building permits of $500,000 or more, and they're fed this information by the city. You may have received one. I know we responded to dozens and dozens on behalf of our clients. So those requests were for costs as of September of 2020, and they also asked you for estimated costs up to December 1st of 2020. And I've looked at many of the resulting assessments, and they contain two major flaws, or at least most of them contain two major flaws. Number one, They adopt costs that were largely incurred in a post-COVID world, in other words, those costs that were incurred during 2020, and they reflect all of the associated overruns and delays and material cost increases and all of those other non-value added expenses that the pandemic caused. And it can't be emphasized enough that these aren't January 2020 costs. We know that some construction categories increased by 10%, 20%, 30%, and more. And to use these for assessment valuation purposes, they need adjustment, and in some cases, substantial adjustment before they can be used, like I said, for valuation. And the second almost systemic flaw in adopting these costs outright is that cost is not necessarily an indication of value. And this is a valuation fundamental that these assessments, and really, in my experience, assessments on partial construction generally don't reflect. What you need to do when you get your assessment notice and decide whether or not you're going to appeal, ask yourself what your project would sell for if you walked away from it on the 1st of December, because that's the value that your assessment should reflect. I'm going to go on a limb and I'm going to guess that it would be a substantial discount from whatever that cost was that was in place. So really you're needing to adjust for two factors. You need to adjust for the COVID related non-value added costs, and you also need to adjust that cost in place to market.
I had a question there, Giselle. It popped on the screen.
Sure.
And you've touched on some of it by now from the time the question was submitted. But this person says, what's my decision rule for appealing a building under construction? For example, if I have $1 million into a new building and it's assessed at $1 million, do I appeal it?
I would say almost without exception, yes, for the reasons that I've just spoken to, because that $1 million cost is reflecting any those COVID related cost escalations that didn't exist in a January 2020 world, first of all. Second of all, I think that there's substantial risk associated with picking up a partially complete project. Assessment is market value or value in exchange, so you need to account for that risk and the resulting discount that would result if you tried to sell it. I mean, these things don't sell, and there's a reason why, right? There's just not a lot of market for them, and that's because of that risk and so on. Hopefully that answers the question. But before we flip the page here on partially complete construction, I would emphasize that COVID is 100% a relevant consideration for construction projects where those actual costs have been used in setting the value. And I think that the vast majority of them are likely overassessed for 2021. Another area, or another property type rather, that have been deeply and probably arguably permanently impacted by the pandemic are seniors housing and other institutional type properties. But again, same question, is that relevant for 2021? And again, the refrain is, well, yeah, it can be. And really what the pandemic has done is that it's illuminated some design flaws in these facilities that were probably, well, obviously were already in existence. And for assessment valuation, these types of shortcomings manifest themselves in valuation speak, functional obsolescence. And what that is a penalty on value, and it can provide a strong ground for appeal. And functional obsolescence can manifest itself not just in seniors housing and schools, but in arguably just about any property type. So it's something that you want to consider when you're evaluating your assessment. Would you build it differently today if you were given a vacant greenfield site than what you're occupying right now? So that's sort of my moment in the sun.
Before you disappear from the sun, there's one more example where you bring up one more question where you bring up functional deficiencies. The question is, and can you give an example of a functional deficiency that was formerly unknown but may have been brought to light by the COVID pandemic?
With respect to any property type, or with respect to?
Well, I guess it could be any, but it rises on this slide here, so it may be pursuant to this one.
Okay, I think we've all seen the tragedy that's unfolded in some of our nursing homes, and some of that has resulted due to the fact that there isn't the ability to distance in these types of facilities, particularly in older ones. For instance, if you have a facility where you have 2 beds per room, that type of inefficiency or inability to distance and it should be reflected in assessments, and therefore or not therefore, but it manifests itself in functional obsolescence, and that type of functional deficiency doesn't necessarily relate directly to COVID either. I mean, those types of facilities have less, the market appeal of those is less, and so that also results in potentially a penalty on value due to functional. So with that, I am going to turn things over to my second in command, Greg Carey, and he's going to tell you a little bit about what's going on with apartments.
Thanks, Giselle. And, apartments was one asset class where we kind of saw a lot of strength, obviously. And further to Andre's point, there was sort of a safe flight effect happening, especially in Atlantic Canada, where we've been fortunate, to have lower than average, I think, per capita rates of COVID, as opposed to the rest of the country. However, in doing so, at the same time, there were a lot of issues being seen, I guess, from the tenant side with regards to evictions and this sort of thing. In response, the government slapped us with rent control, which they staunchly said they would not enact until they did, and then now we have a rent control. There's a cap on rental increases, as well as limits to who and when you can evict tenants. So obviously these are huge challenges that facing the apartments that otherwise weathered the storm quite well, and even outside of COVID, we've been seeing lower vacancy rates and that sort of thing. So the sector looked strong, but now there's going to be limitations to that, especially if you've got a property with deferred maintenance, kind of as Giselle mentioned, or needs improvements, that sort of thing. You're going to have a harder time increasing your rents. You're going to have a harder time getting tenants out so that you can make improvements, especially where properties, genuinely and direly need these improvements. So that's going to be an issue moving forward. At the same time, and this touches again on a little bit on what Giselle had said, the cost of both building materials and skilled trades have increased substantially. I've heard some clients of ours saying that skilled trades, the prices on skilled trades are up 30%. I've heard softwood lumber products are up as much as 300 to 400%, so 3 to 4 times the cost. So what you're seeing is maintenance costs more, renovations cost more, your costs are increasing. In addition to this, another sort of single line item that we've seen a lot of increases with are rising insurance costs, and you can't offset that with an increase in your rents, which you'd normally do. You need to make a profit, but you also need to cover your costs. I've heard of people paying 20, 30, 40% more for insurance this year. We had one client whose insurance premiums went up 20%, and the broker told them to take it and run because this was the best deal that they had seen, and it wasn't going to get any better by fighting it. Of course, and what we're all here for as well, is increasing property taxes. Again, those costs are increasing and you can't increase your rents. So especially where you may have deferred maintenance, that sort of thing, the costs for operating your buildings are increasing, the costs for renovating your buildings are increasing, but you can't increase your rent. So this is going to be a consideration moving forward, of course, for your apartment properties.
So, Greg, if you have a second there, I do have a question that came in from presumably a owner of our portfolio. And this person says, apartment assessments, as we know, are based on income and expenses. So how does buying power factor into that? For example, if I have 10 apartment buildings, I can get a lower cost per liter for my heating oil than somebody who owns just one building. So is my assessment going to reflect my lower cost of oil, or will I be treated equally to an owner of a single building?
It's a great question. That kind of depends. It could be the case that if you've been submitting your income and expense information based on those lower costs, you could see a higher assessment because of your buying power. You need to challenge that. If you've got access to economies of scale, you get a lower price per liter of oil, or whatever the case may be. It's not the value to you for your assessment, it's the value to any owner. So what would it cost Andre or I to buy your apartment building and run it if we can't buy oil for 10 buildings at once? In fact, we've been successful at the Nova Scotia Assessment Appeal Tribunal arguing this very point, where we had a owner operator of a large apartment portfolio, and he's able to do something like buy 50,000 or 100,000 square feet of flooring at once and to store it on one of his properties. So he's got, obviously it's cheaper to refinish 100 apartments than it is to refinish one apartment, and he's got the labor as well. So his costs are lower across the board, but it's not the value to that one owner, the value to any owner. So those types of advantages that you might have shouldn't be taken into account in your assessment. Thanks, Martin. That's a great question.
I guess
And just
to add on the end of that, maybe it's safe to say the assessors don't know about it unless you point it out. As far as they're concerned, they just see an oil cost there. They don't know that you've spread that across 15 different buildings that are all under separate numbered companies. So they wouldn't know that you've got a discount for buying power there unless you point it out to them.
100%, and that's what the appeal process is for. And further to that, you know, you've got economies of scale, especially we see this with management, both in very large and very small portfolios. You either don't charge a management fee or you're able to spread it over a huge number of units. And those costs are, I don't want to say artificially low, but are experienced lower than it would be for somebody on a standalone basis for that type of property. And just moving on to sort of the investment grade commercial properties, retail, offices, and industrial. Obviously, of course, retail, we've seen lots of highs and lows, and certain classes of retail falling out of favor at the base date. And of course, we've heard countless stories of COVID, you know, crippling and eventually companies succumbing to the pressures that it's put on them. You know, old retailers that Canadians are familiar with across the country and that are, you know, staples in whether it's malls, power centers, what have you. And those retailers have been forced out of business and left their stores dark. And the question is, you know, if you've got an empty space as of the base date, and again, the base date for 2021 is December 2020. If you've got a vacant space that was fit up for somebody else, what's that worth on the open market? What's a vacant fast food restaurant that's completely branded worth to a different company? What's a different clothing store worth to a different company? And if those spaces are vacant and were forced to be vacant by COVID, that's a relevant consideration. And again, so does COVID affect these things? Well, unfortunately, it depends, and it can. In offices, it's interesting. Nathan, who we saw at the start of the call, is also the manager of our space measurement division. And he said among some large institutional operators, they're seeing a lot more subdivision and smaller office work. So taking one tenant space of, let's say, 15,000 square feet and chopping it up into the 3 spaces. And of course, we've also seen a massive shift to work from home. How many of those workers are going to come back to the office? Well, if your office shut completely, or if your tenant's office shut completely, well, they might not be coming back. That space might now be fit up for a different tenant, for a different use, for someone else, and that might not have value. So it's important to look at the space, the physical spaces themselves, and, you know, really review who your tenants are, what those spaces are like, and if they've got value. And if, you know, you've been forced, if tenants have been forced out of your building by COVID, or if their operations, the way that they operate has changed, it's worth considering, you know, challenging your assessment and seeing whether those things should be affecting your assessed value and ultimately your property taxes.
All right, well, thanks, Greg. I think if I was going to sum it up on the COVID side, if you have an issue that is either physical with the property or relates to an occupancy of the property, or even tied back to the occupancy of a property, we would argue that that's a relevant factor to consider in an appeal this year. COVID aside, I wanted to throw this case study on the screen before we close. This was an example of a stagnant assessment that an owner had for 7-8 years. The assessment was in line with what the investment was in the property, and they never once challenged it. A new manager came in and decided for the first time they wanted to review it. And we were able to quickly find that there was a mezzanine that was in the original drawings that was never built. So this was an error that was in that property for about 7 years, and it knocked the taxes back by about 13%. So, you know, over 10 years, it would have been close to $200,000. And this is an assessment that had been stagnant. Nothing had changed at all, but a manager took the time to review it and made that change. You know, it was successful in getting that reduction. And these are the other examples of stagnant assessments where we've come in over the years. You're looking at between the properties in the photos and the portfolios that go with them, you're looking at millions of dollars in property taxes, that came from reductions in otherwise stagnant assessments. So I'd encourage you to look at how COVID impacted your property, but I'd also encourage you to look closely at your assessment this year, because when things are good, we often forget to look back at some of the, when money's growing, we spend less time looking at our costs. So there's never been a better time to scrutinize your operating costs this year, and that means scrutinizing your assessment. So with that, we told you we'd take 30 minutes, that is, and we did. But if anybody would like to reach out to any member of our team to discuss any issue related to an assessment or review any question that you have at all, please feel free to do so, and we would be more than happy to take care of you. And hopefully we'll see people at the next one.
I'll also mention just quickly, Andre, that there's a copy of the webinar will be posted on our website for future reference for anybody that needs it.
Excellent. Take care, everyone.